The impact of the US Federal Reserve's recent rate hikes could be seen in the higher net interest income reported by all three local banks. DBS saw net profits increase 7% from a year ago. UOB's net profit rose 11%, while OCBC jumped 28% in the second quarter. The higher net interest income also offset lower fees from weaker capital markets and improved all three banks' net interest margin, or NIM, a key gauge of a bank's profitability. Analysts expect the NIM to continue improving for the rest of the year. However, they also remain cautious about potential headwinds facing the banks.
On one hand, Singapore banks, they are quite well positioned in terms of their funding profiles, with them having a predominantly customer funding base and large floating rate loan composition. So with the very hawkish Fed stance, they are poised to benefit from the stronger NIM expansion to come as these books reprice on higher benchmark rates. On the other hand, the higher inflation that affects growth prospects, with customers thinking twice about their expansion plans and the accompanying higher interest rates that makes monthly loan repayments a bit more expensive.
While overall loans growth remained resilient in the second quarter, there is concern that this will slow as the momentum from economic reopening fades and more rate hikes push the global economy closer to recession. This would impact the asset quality of a bank.
The biggest concern that we have is on asset quality. As conditions slow down, there is a risk of this deteriorating, especially for sectors like SME, construction, property. Even things like mortgages. We are going to see mortgage rates that we haven't seen in over a decade by the end of this year, from 3.5–4% if the Fed rates continue to go the way it is going. So we do expect provisioning levels to go up. And I think a lot of the provisions that was taken during the COVID period of 2020 and 2021, there was some expectation that these will be written back, but I think the banks will hold off on that.
Analysts are also watching the non-performing loans, or NPL ratios, of the three local banks.
We do expect NPL ratios to rise from the current low level. But at the same time, if we look at domestically, if we look at Singapore, we are still looking at a very tight labor market. So that's going to fare well, and that's going to support the bank's asset quality. Now, of course, the Singapore operation only make up about 2/3 of the Singapore bank's entire loan book exposure. So we also need to be watchful about what's happening in China as well as the broader Southeast Asia reopening, because China's slowdown tends to have a second-order impact towards the broader Asia region.
However, analysts agree that prospects remain bright for the sector, as it will continue to benefit from expected future rate hikes by the Fed. Wealth management continues to be an area of focus for banks, despite lower contributions from this segment in Q2.
Wealth management will definitely be one of the key areas of growth. As we've seen, assets under management has continued to increase in Singapore, particularly because of Singapore's safe haven status. And I think the product sophistication that is offered by the banks have also gone up quite significantly. So I think if you do start to see market conditions turn, eventually this will be a fairly strong segment for the banks to return to growth as well.
Overseas expansion will also be a key driver of growth.
I think for the Singapore banks, the differentiator really lies on the overseas operations expansion, right? So for UOB, the bank is focused on the Southeast Asia region. The bank would like to expand this area more broadly, and DCT consumer acquisition in parts of ASEAN, it's part of the bank strategy on that front. For DBS, the bank is more focused in India. The bank would like to triple its franchise in India. So that's one area to look out for. For OCBC, I think the bank is quite focused on in the Greater Bay Area and also like wealth management within that area.
Both Maybank and CGS-CIMB are bullish on the shares of all three banks and have placed a buy call on them.
What's underpinning our calls for these banks is the NIM expansion to come. That should come in a bit more substantially in the second half of this year. We think share price may re-rate going forward, especially if asset quality fears, those are unfounded. If credit costs manage to stay low or around the current levels, we think that the earnings upside from the margins will offset any weaknesses in non-interest income, whether a rise in OPEX, and ultimately drive valuations higher.